equation here, and we're going to say we don't want to assume we have to know what this I and what this gx are in order to solve our model. We're going to want to be able to calculate what they are by looking deeper at what their determinants are. And we're also going to start looking at changes relative to baselines. We're going to start putting big Greek letter deltas, these triangles resting on their base, in front of pretty much everything. We're no longer going to be talking about whether the level of real GDP is 15 trillion or so in equilibrium. We're going to say if X happens, then the level of GDP will drop by 500 billion or so. Why are we just going to look at changes relative to some baseline growth path? Well, two reasons. The first, if we do so, we can have simpler formulas because we can drop out terms that do not change. And we're going to have complicated looking equations, and if we can simply say this doesn't change, this is a zero, all of a sudden our equations will become comprehensible. Second, whenever we're dealing with depression economic situations, there is in the background this underlying long-run growth trend from the growth economics section going on. And having to incorporate that into our calculations would raise them to another order of complexity we'd rather not. We'd rather assume that there is some growth trend baseline path back there, and we are just interested in deviations from it. That is, we're dividing the state of the economy into a trend part and a business cycle part, and we just for a while want to look at only the business cycle part. And so we put these Greek deltas in front of everything to stand for change and to stand for difference between the level of this variable and its smooth growth path long-run baseline. And I'm also going to want to say that this baseline consumption plus investment plus government plus gross exports term, I'm sometimes going to want to call this by the big letter A. A standing for autonomous spending. Autonomous meaning that it's spending that doesn't depend on the level of real GDP. It's spending that doesn't depend on the level of income, and it doesn't depend on the interest rate. Because we're going to want to find what the level of income is, and so having some of our variables that we're looking at depend on income would be annoying. And because we're going to want to vary the interest rate, which means we're then going to want to divide up components of spending into those that do vary with the interest rate and those that don't. And for those that do vary with the interest rate, we're going to want to call those baseline autonomous spending, A sub 0. Kind of like we call those parts of consumption that didn't vary with income baseline consumption spending, C little 0, with 0 counting as relative, meaning that it's some baseline quantity. And also note these little things with subscripts that we've been using for a while. C sub y and IM sub y. This is kind of a convention that helps keep things slightly less confusing. Whenever you see something with a subscript, it's going to mean that it's not itself a variable that moves, but rather a parameter that tells you the responsiveness of something. What's the responsiveness? Well, this CY is the responsiveness of consumption C to changes in after-tax income. This IMY is the responsiveness of import spending to changes in after-tax income. Keep that in mind because there are going to be a whole bunch of such things flying around the screen fairly quickly. So we have our C0 here in autonomous spending determined by consumer confidence. We have this G, this government purchases, determined by politics. And the tax rate T is determined by politics too, but it doesn't change nearly as much. What determines investment spending by businesses? And what determines gross exports? Those are the next things that we're going to want to tackle. Well, to put it in brief, investment spending, we're going to say, is determined by two things. First, by business confidence. How confident are businesses that they'll be able to sell stuff they make if they build up their factories? Or are they terrifically depressed? And B, how expensive is it for them to borrow and invest? Or perhaps how attractive is it for them to take the cash they have and lend it out in financial markets rather than spend it building up their capacity? And for that, the cost of capital that really matters to businesses is the long-term risky real interest rate R. Is the interest rate you have to pay or that you receive when you make not short-term 3-month investments, but long-term 10-year investments. A real interest rate, not a nominal interest rate. That is, we're not interested in the number of dollars that you get from loaning or that you have to pay back when you borrow. We're interested in the number of commodities, or the value of commodities, which means that we want to subtract the rate of inflation from whatever interest rate is quoted to us by the bank or by the bondholder in order to figure out what its real inflation-adjusted interest rate is. And we're not going to be looking at the interest rate on safe investments because businesses are not safe things. When they invest in a factory, who knows what things are going to be like 5 or 10 years down the road. If you make a risky investment, you expect a higher rate of return, a higher interest rate. And if you are a borrower that's itself risky, you have to pay a higher interest rate in order to borrow. We're interested in those risky interest rates rather than the interest rates on safe government bonds. So we're looking at the long-term real risky interest rate R as a determinant of investment spending. And for exports, the other component that we're interested in, well, those are determined by foreigners' incomes and by the real exchange rate. This script E, this epsilon, this value of domestic currency relative to foreign currencies. Again, adjusted for changes of inflation. This thing that determines whether the products that we tend to make are relatively cheap or relatively expensive in the world as a whole. So we're going to write down our equation for investment spending, and it's going to have a delta in front of it because we're interested in looking at changes or at differences relative to some long-run economic growth baseline. And it's going to be delta investment spending. And the first term is going to be this I0 term, this business confidence term. This term that says that businesses will spend more when they're more confident about the future. That's what the 0 means. It's a baseline that depends on confidence. And then minus this I sub R delta R term, minus the sensitivity of business investment spending to the real long-term risky interest rate, times the deviation of the real long-term real interest rate from whatever your baseline is. Why the minus? Because when interest rates go up, it's more expensive to borrow, and businesses' investment committees are more likely to say we shouldn't undertake this increase in our capacity. Look at how much we'll have to pay in interest in order to finance it. When interest rates go up, business investment spending goes down. How important are these two things? Well, they're about equally important. That the Federal Reserve has since late 2008 been trying to do a whole bunch of things to try to diminish, decrease, and minimize this long-term real risky interest rate. That the Office of Management and Budget more when it was headed by Peter Orszag in the first year and a half of the Obama administration than now when it's headed by Jack Lew, who has less of a high profile. That Peter Orszag was all about going around and talking to businesses and saying that, yes, the Obama administration has a plan for getting the long-term future of the American economy back on even keel by balancing government spending and taxes over the long run. You, as businessmen, shouldn't worry that if you invest in a factory now, we'll impose confiscatory taxation on it in 15 years to pay for Medicare. We're going to actually do something to slow the growth rate of Medicare. So your confidence can be high and you can invest a lot in adding to your capacity without worrying that that value will simply blow away and disappear. Those are the two determinants of business investment spending we're going to write down. And once again, it's not as though there's an investment equation buried in the soil somewhere. That this is a simple, rough approximation to a complicated process involving tens of millions of businesses, each of which is undertaking its own decisions to invest or not to invest, and so add to its productive capacity, or not add to its productive capacity. The hope is that if we get a handle on three aggregate magnitudes, business confidence on the one hand, the sensitivity of the average business to changes in interest rates on the other, and the long-term real risky interest rate, we'll be able to do a good enough job at modeling and predicting and tracking business investment spending to have some quantitative conclusions come out that are actually worth something. So here we have it again, the change in business investment spending on the left, the change in business investor confidence in the first, the sensitivity of business investment to the interest rate misspelled on the second, and the change in the interest rate relative to baseline on the third. That's going to be our investment equation for this course. If we were my teacher, Olivier Blanchard, if we're using Olivier's textbook, there'd also be an accelerator term in there having to do with the level of real GDP, because Olivier rightly says that businesses are much more willing to invest when the overall level of demand is high, and when they know they've got lots of customers. We're not including that here just to make things simpler. It might be there in the background. I'm not going to ask you about what would happen if that effect is important. We just don't have space. Besides investment spending, we also have gross exports, which we said depended on the exchange rate. And then we got to ask what determines the real exchange rate. That is the value of the home currency, the value of the dollar. Well, the value of the dollar in terms of foreign currency right now is determined by a whole bunch of people. We used to call them the burghers of Amsterdam. Then for a while we called them the gnomes of Zurich. The British government especially would denounce the gnomes of Zurich that were pushing down the value of the pound and embarrassing it. There were a couple of stories that financial reporters wrote in the 1960s which claimed to be interviews with an actual gnome. Nowadays they're on Wall Street, on Canary Wharf in London, in Frankfurt, in Tokyo, all over the world. The biggest speculator on foreign exchange right now is the single organization called the People's Bank of China. And the level of exchange rates in international currency markets is set by what these particular bunches of speculators are willing to pay for different currencies. And in general, you can say that it depends on two things. That the real exchange rate, the value of the home currency, is determined by the average of speculator confidence in the long-run value of the currency, and on the difference in interest rates between home and abroad. And why is this so? Well, it's a balance between fear, optimism, and greed on the part of all of these people. The fear part. If your currency is high relative to its long-run baseline, it's not going to stay high forever. It's going to come back to normal at some point. That means that if you invest in it now and hold it for a year and then sell it, you've got to fear that it will come back to normal during the year that you've held it, and you will take a very large capital loss. So that's the fear part, that if your value of your currency is high, it might go down. Then there's the optimism part. Right? If you believe the future is bright for the dollar, you'll be willing to pay more for it. Then there's the greed part. If interest rates at home are higher than interest rates abroad, say here in the United States, where long-term real risky interest rates are on the order of 5% per year, as opposed to Japan, where they're on the order of 1% per year. Invest your money in a United States bond, and you make denominated in dollars, you make 5% per year. Invest it in a yen bond, you make only 1% per year. That's about 4% per year in extra money. If you're greedy, you'll say, I want to buy dollars and invest my money in the United States in order to get that extra return. That's greed. That's fear. If the value of the dollar is high, the fear can be counteracted by optimism. And this parameter here, this sensitivity of the exchange rate to changes in the real interest rate, that's the balance term. And the way these fear, optimism, and balance and greed terms are all going to work out is that the deviation of the exchange rate from baseline is going to be equal to this term that depends on speculators' relative optimism, plus the sensitivity of the exchange rate to the interest rate, times the gap in interest rates you get between holding your money, holding your wealth at home, and holding your money abroad. And let me stop there, and I'll go over this again at the start of the next lecture.